studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
In this example, we move from profitable corporations to a situation where the corporation has incurred a business loss. At first, a corporate loss may seem like bad news. However, from a tax perspective, a non-capital loss can actually become a valuable tax-saving opportunity. A non-capital loss occurs when the corporation's allowable business expenses exceed its business income for the year. In other words, the company spends more than it earns, resulting in negative taxable income for that taxation year. Fortunately, Canadian tax law recognizes that businesses do not earn the same amount of income every year. Some years are profitable, while others may experience temporary losses. Instead of letting those losses go to waste, the Income Tax Act allows corporations to use them to reduce taxes paid in other years. This is where Schedule 4 becomes important. Schedule 4 is the CRE schedule used to track a corporation's non-capital losses. It records the current year's loss and helps determine whether that loss should be applied to previous years as a loss carryback or saved for future years as a loss carryforward. Think of a non-capital loss as a tax asset rather than simply a financial setback. Although the corporation has lost money in its business operations, that loss has tax value because it can reduce taxes that have already been paid or lower taxes that will be payable in future profitable years. One option is a loss carryback. If the corporation earned taxable income and paid income tax in previous years, the current year's loss can be applied against those earlier profits. As a result, the corporation may receive a refund of some of the taxes it previously paid. In effect, the CRA returns taxes that are no longer payable after considering the loss. Another option is a loss carryforward, where the corporation saves the loss for use against taxable income earned in future years. We'll explore that strategy in more detail later. But for now, it's important to understand that the corporation has a choice. The overall process is straightforward. The corporation incurs a business loss. That loss is recorded and tracked on Schedule 4. The corporation then decides whether to carry the loss back to recover taxes already paid or carry it forward to reduce taxes in future years. Either way, the loss creates valuable tax savings. The key takeaway from this slide is that a corporate loss is not wasted. Through Schedule 4, a non-capital loss becomes a valuable tax asset that can generate an immediate tax refund through a carryback or provide future tax savings through a carryforward strategy. Now that we understand what a non-capital loss is, let's see how a loss carryback actually works. This is one of the most practical tax-saving strategies available to corporations, and Schedule 4 is the tool that makes it possible. Imagine a corporation that earned taxable profits in the first 2 years of operation. Because the business was profitable, it paid corporate income tax to the Canada Revenue Agency in each of those years. Then, in the third year, business conditions changed, and the corporation incurred a significant non-capital loss. Since there is no taxable income in the current year, the corporation cannot use the loss immediately to reduce its current year's taxes. Instead, Canadian tax law allows the loss to be carried back and applied against taxable income reported in previous years. This process begins with Schedule 4. The schedule records the current year's non-capital loss and determines how much of that loss is available for carryback. The corporation can then apply the loss to prior profitable years, starting with the most recent year first, and then moving backward if any loss remains. As the loss is applied to prior years, the taxable income reported in those years is reduced. Since the corporation originally paid tax on higher taxable income, it has effectively overpaid its taxes. The CRA recalculates the taxes for those years and refunds the excess amount to the corporation. For example, suppose the corporation earned profits and paid taxes in year 2. If part of the current year's loss is carried back to that year, the taxable income for year 2 decreases. As a result, the tax that should have been paid also decreases, and the CRA issues a refund for the difference. If there is still some loss remaining, it can be carried back even further to year 1. Notice that Schedule 4 carefully tracks every step of this process. It records the original loss, the amount applied to each prior year, and any remaining balance after the carryback. This ensures that no portion of the loss is used more than once, and that the corporation receives the correct tax benefit. One important rule to remember is that a carryback can only reduce taxable income that actually existed in a previous year. It cannot create additional taxable income, and it cannot generate a refund greater than the taxes that were originally paid. The entire workflow is simple. The corporation incurs a current year loss. That loss is recorded on Schedule 4. The loss is applied to prior profitable years. Those years' taxable incomes are reduced, and the CRA refunds the taxes that were overpaid. The key takeaway from this slide is that Schedule 4 acts as the corporation's loss management tool. It ensures that non-capital losses are applied correctly, tracked accurately, and converted into valuable tax refunds whenever previous taxable income is available. Now that we've learned how a loss carryback works, an important question remains. Should every corporation automatically carry its losses back? The answer is no. Choosing between a loss carryback and a loss carryforward is a strategic tax planning decision. The first question an accountant asks is whether the corporation paid income taxes in previous years. If the answer is yes, then a loss carryback may be an excellent option because it allows the corporation to recover taxes that have already been paid. When the loss is carried back, Schedule 4 applies the current year's non-capital loss against taxable income from prior profitable years. The CRA recalculates the taxes for those years and refunds the excess tax that was originally paid. This provides an immediate cash benefit to the corporation. Receiving a tax refund can significantly improve the company's cash flow. Instead of waiting for future profits to benefit from the loss, the corporation receives cash from the CRA much sooner. For businesses facing temporary financial difficulties, this immediate refund can provide valuable working capital. However, not every corporation has taxes available to recover. Suppose the corporation is newly incorporated or did not earn taxable income in previous years. In that situation, there are no prior taxes to refund, so carrying the loss back would provide little or no benefit. Instead, the corporation may choose to carry the loss forward. A carry-forward preserves the non-capital loss, so it can be applied against taxable income earned in future profitable years. When the business returns to profitability, those saved losses reduce future taxable income and lower future income taxes. In some situations, a carry-forward may even provide a greater tax advantage than a carryback. For example, if management expects much higher profits or higher corporate tax rates in the future, saving the losses for those years could generate larger tax savings than claiming an immediate refund today. This is why experienced tax professionals don't automatically select one option over the other. They evaluate the corporation's past tax history, its expected future profitability, available losses, cash flow needs, and overall tax planning objectives before deciding which approach creates the greatest overall benefit. The decision process is actually quite simple. If prior year's taxes have been paid, consider whether carrying the loss back will generate a valuable refund. If there are no prior taxes to recover, or if future tax savings are expected to be more valuable, then carrying the loss forward may be the better strategy. The key takeaway from this slide is that a corporate loss is never automatically wasted. It represents a valuable tax planning opportunity. Whether the corporation chooses a carryback for an immediate refund or a carry forward for future tax savings, the objective is always the same: maximize the overall tax benefit for the business.